Egypt's central bank unexpectedly held its target interest rate steady at 16.25%. Most economists had called for a rate hike. Bloomberg's Simone Foxman has more. Simone, so caution then behind this decision.
Exactly. The central bank has done about 800 basis points of rate hikes over the last year. And so the Monetary Policy Committee sending the message that this front-loaded tightening, it wants to simply see what the impact is going to be and how exactly this will play into the numbers. And there's a couple things that are sort of on the table that the central bank is likely going to be watching for. First, we're just going to get inflation data for January out late next week. The second, the devaluation of the Egyptian pound. That has been continuing to play out in the markets. We saw some of that early in January, and we've been seeing a steadily weaker pound over the last couple of days. And finally, most people are anticipating that there is going to be a hike in fuel costs, and that could also have an impact on inflation. Economists warning, though, this does not mean an end to the tightening cycle in Egypt. It just means it's not happening at this meeting. And frankly, we've seen the central bank make a lot of moves outside of its scheduled meetings. Its next one's scheduled for March 30th, but perhaps we're a little bit data dependent here. So I think it stands to reason that we could see some move either outside of that schedule or additional moves come March and beyond.
Mm-hmm. And then another central bank news, Saudi Arabia has replaced the head of its central bank. What do we know about the new guy?
Well, he's called Ayman al-Sayadi, and he's a long-time vet of the central bank. He's been there since 1999 and has been serving as the vice governor for investment and research. He's been particularly involved with international and local debt sales for the kingdom. And this kind of turned on a light bulb for me because one of the things that a lot of analysts and investors have been telling me is that the development of deeper local capital markets may be a way of mitigating some of these liquidity pressures that the banks are facing, help them do better at balancing that mismatch between credit and deposits. And so do we see perhaps the development of a deeper local debt market? That's a question that I'm wondering and I'm going to be following for sure. Also worth noting, Fahad al-Mubarak, the previous central bank governor, he is not out of the picture. He's simply going to be an advisor for the royal court. Yusuf?
Yeah, and I'm sure he's going to continue to avoid doing any television interviews. In the meantime, we get our latest read on inflation in Turkey today. What are economists expecting?
Well, they're expecting the headline number to fall. It was 64% for the month of December. They expect it to go down. The median estimate is something like 54% for the month of January. Mainly, this is base effects. We saw these massive inflation numbers back last year. So, of course, the inflation numbers this year don't look quite as staggering. There's also potentially the impact of some price freezes that we saw at grocery stores. This was an appeal the Turkish government made to grocery stores not to raise their prices, and so that may play into a little bit of the data we get. But this number is really important, not just because of the scale of the cost of living crisis, but because it's important to what the central bank can do. And economists increasingly talking about how the central bank may actually continue to cut rates. I know that seems crazy, but of course, President Erdogan's monetary policy, his belief is that if you cut rates, you lower inflation. Of course, most economists don't believe that. So if we saw a lower than expected inflation number today, if we see aggressive rate cuts from here, economists say we could see the potential for inflation much higher than the 30% they're targeting at the end of this year.